Hey everybody, it is Todd Seymour once again for Let's Talk Money. And today's topic is going to be a common one, especially with my younger clients, and which is better, a traditional or a Roth contribution to a retirement account. And I put retirement account because it doesn't really matter if it's a 401k, an IRA, 403b, all those code sections just tell you basically where you're working. And so we're just trying to figure out what's the best one to contribute to. How are we going to get the best tax benefit? So in order to talk retirement accounts, if money is not exciting enough, we have to just briefly talk about taxes. Now, don't let that intimidate you with this video because you have to realize a little bit. Most of you, this is why you did not become an accountant, because you didn't want to do taxes. But again, you need to understand it and where I'm coming from. And actually today, normally I don't like to give too much advice, but I'm going to tell you pros and cons of each one. And let's start with the basics though on what is even a traditional IRA and a Roth IRA. So a traditional IRA, you get a tax deduction now. But when you take out money, you pay tax later. And then a Roth IRA simply is just the complete opposite. Basically, you get no tax deduction now, and then you pay no taxes later. And so the biggest thing that I hear feedback from, again, especially younger clients, many of my clients that are retired never had the opportunity to do Roth contributions. So when they're pulling money, they're only taking money from traditional. And I wanted to kind of give you real life examples on 3 clients' tax returns, just so you can understand why, in more cases than not, a traditional vehicle is much better than a Roth, despite what you hear all the time. And you're right off the bat, you're going to say, but Todd, you've already told me that there's no taxes later. You know, I want to have this tax-free vehicle. And my comeback to clients that say that is, the first thing that you learn in finance is a dollar today is worth more than a dollar tomorrow. And it's true, because if I have a dollar today, I can invest that dollar and it's already working for me before tomorrow comes. And so if you can save money on taxes now, then we talk about this in another video on the best ways to save for retirement. You're going to get multiple benefits by doing the traditional over the Roth. Now, I'm not saying that you shouldn't have a Roth at all. I talk to clients all the time about how we want these different buckets of money, right? And the different buckets of money are the Roth and the traditional, and we want different ones. So if you have a payroll deferment plan, which is like a 401k, a 403b, etc., those are taking money away from your pay that you don't get to see, which honestly we would all agree is the best way, because not all of us are good at saving money once we get it in our hand. And most of the time we have employer matching to that payroll deduction. So those are the best routes to go. And a traditional is usually the best route, even though you're going to pay tax later. And again, here's a great example. Here's your quick tax overview. So there's 3 clients, all different scenarios in income. And I think the reason why I put especially the first 2 is to give most of you some way to kind of compare yourself. A lot of times when they show examples, it's just out of control and you can't relate it to. So let's look at the first 2. The first 2, AGI is adjusted gross income. So it's basically the income that you're being taxed on. And the pushback that clients will give to me is that, yeah, but taxes may change, and what happens if they do, and now I did a traditional and taxes go up. So I go back and say, I've been doing tax returns for clients for 27 years and I've never seen taxes go up. I feel like they will, but in life, you're going to learn when you do any type of planning that you plan for today. So I'm planning for what I know right at this moment. And so this client, take the top one first, $50,000 in income. And that income consists of, by the way, these are all retirees. So they're pulling money from traditional IRAs, about 20,000 of that. Then they're taking dividends and Social Security, just like all of us will be. And I promise you, Social Security will be there when you retire, just at a reduced rate, but it'll be there. So I got $50,000 in income, $2,900 in taxes due on that $50,000. It puts that client in the 12% bracket, or what's called an effective rate of 6%. And so you should say, what's an effective rate? And that is what you're really paying tax at. So if somebody says to you, yeah, I'm in the 12% bracket, because you're getting dividends and Social Security and traditional IRA distributions, all three of those are taxed at a different rate. And they always will be, by the way. When you look at a tax return, the reason why tax returns get so complicated is because every line on that return is taxed differently. So clients in a 12% bracket, because of dividend and Social Security income, it's making them truly pay tax at 6%. Now, I tell clients all the time, and I know all of you that are working, you're paying payroll tax higher than 6% today. So let's go to the next one, just so you get to see an example. Now we're going to double this client's income. It's actually a different client. They've got a little bit more in IRA distributions. That's why it's pushing it up to the 100. Still, tax due is $47.50. And believe it or not, this client with $100,000 is still in the 12% bracket. And the effective rate, and these are real tax returns, by the way, that I just did for all three of these clients. So $100,000 in income, tax due is $47.50, 12% bracket, 6.5%. Now again, today I'm working and all of my income is ordinary income taxed at this rate. That's taxed at your ordinary rate. So if you were working, your $100,000 would be taxed at that 12%, not the 6.5 or the 6. So your tax due would be double. And wouldn't you rather have the tax benefit on the full 12 today as opposed to paying less tax when you retire? And that's the reason why I keep pointing out the traditional, because I can get the tax rate today at my true tax rate. And many of you are paying a much higher rate than 12%. And if you work in a state that has state income tax, you're saving not only federal tax by doing the traditional, but you're saving state tax on top of that too. So the big thing that always surprises clients is, let's look at this client here with $381,000 in income. That'd be awesome, right? They're married couple. His required minimum distribution from his traditional IRA, I had to write it down, it's $114,000 of that 381. So his tax is $59,000. Seems super high. But what if I told you that client is in the 22% bracket, which again, many of my younger clients are much higher than a 12% bracket. The crazy thing is his effective tax rate, and I say his, but their effective tax rate, what they're really paying tax at is only 16.6%. Crazy. They're making $381,000 in retirement. And that's the tax that they're actually paying to the government. 381, 16% is roughly $59,000. And that's with the client taking a standard deduction. All three of them have taken the standard deduction. It's just simply amazing that clients sometimes, again, it's a hard thing when you deal with money is to look into the future. You're always thinking about the now. And everybody, all the time, I say the hardest part about dealing with money is you hear so many different opinions. And the beauty of working with my firm is that we deal with money when it comes to investing And we also deal with the tax and estate planning implications. And not many people can do all of them and can give you this black and white or green and purple and orange. But at least you get the point. You say, man, Todd, so you're telling me if I do a traditional 401k, I'm going to save at my true tax bracket plus what my state bracket is if that's applicable, and I'm not going to have to pay tax on any of that. No, that you'll definitely come further ahead. Imagine you're giving your retirement a 12% or 15%, whatever bracket you're in, you're already giving it that boost because you're saving that on taxes. And what I tell many of my young clients, and I'll leave you with this, is that I'm not saying that you shouldn't do a Roth at all. I'm just saying that the majority of your money when you're working should go to your traditional, and then the residual amount, if you're going to save, should go into your Roth. So let me give you one last example, and then I'll leave you at this. Let's say you budget and you've got $12,000 that you can put away in retirement. That's your total budget for that. Then think about doing $10,000 into your traditional through your 401k, and then make a $2,000 Roth contribution. So you're just making buckets for yourself. And your traditional bucket may be bigger. You may have to pay tax on it later, but you're going to save that much guaranteed, because if you know your rate, you're going to save it right off the bat. And it'll definitely help your portfolio out in the long run because you're giving it that boost of saving taxes. You're going to put money into your 401k, and when you file your tax return, you're actually going to get a check back for saving into those retirement plans. And some of my clients that work even take that check, that refund that they got because of putting money in a traditional 401k, they use that refund to then contribute to their Roth. So they're letting their contributions do that, and it's just building up your retirement. And it doesn't matter if it's $12,000 or if it's $5,000, just break them up in different pieces with the majority of the money going into traditional. No, it's a lot. We talked about, money is such a tough thing and everybody's different. But again, from the most part, over the 27 years I've been doing this with taxes and everything, the cool thing that when I've been doing it so long, I used to never think this, but now when I'm working with clients' grandchildren and we're talking about this, I can talk to them and say, listen, when I talked to your parents when they were working, or your grandparents when they were retired, we were able to see that what I told them in black and white actually comes to fruition. And it's such a hard thing to think about the future. That's why, again, plan for the now. You know the now. So take advantage of the tax situation, and it will work out in the long run, absolutely. So as always, if you have any feedback, questions, follow up, taxandtrusthelp.com or taxandtrusthelp@gmail.com is the way that you can reach out to us. I always love to hear feedback. Give me some ideas on some videos, and I hope you have a great day, and thanks, and hope you learned something on this. Take care.